Welcome to House Lux Estate, your premier destination for financial freedom. Today, we'll dive into a fascinating topic. Here at House Lux Estate, we strive to empower you with knowledge and strategies that will enable you to navigate the world of personal finance with ease and confidence. Our primary goal is to help you achieve financial freedom, and one of the ways to do that is by understanding and leveraging the power of dividends. Yes, you heard it right, dividends. Today's video is all about how to retire on dividends alone. It may sound like a dream, but with the right planning and investment strategies, it's entirely possible. After all, preparing for retirement isn't just about saving. It's about growing your wealth in a way that allows you to live comfortably without relying on a regular paycheck. So if you're ready to learn how to make your money work for you even when you're not, stick around. Before we delve into our main topic, let's establish what dividends are. So imagine you're a shareholder in a company. You've invested your hard-earned money into buying shares of this company because you believe in its potential. Now, when this company makes a profit, it has a choice. It could either reinvest all of it back into the business, or it can choose to distribute a portion of these earnings back to its shareholders. This distribution is what we call dividends. Now, dividends can be thought of as a thank you gesture from the company to its shareholders for their trust and investment. They are usually given out on a regular basis, often quarterly, and are expressed as a fixed amount per share or as a percentage of the current market price, also known as dividend yield. However, it's important to note that not all companies offer dividends. Some businesses might choose to reinvest all their profits back into the company with the aim of fueling growth and expansion. These are typically younger, growth-oriented companies. On the other hand, well-established companies with steady cash flows are more likely to distribute dividends. So, in essence, dividends are a way for you to earn a portion of a company's profits just by owning its shares. It's like having your cake and eating it too. Now that we understand dividends, let's jump into how you can retire on them. To retire on dividends alone, starting early is key. It's a simple principle, yet one that holds immense power. The sooner you begin investing, the more time you allow your money to grow and multiply. This is where the magic of compound interest comes into play. Picture compound interest as a snowball rolling down a hill. As it rolls, it gathers more snow, growing larger and faster with each rotation. Similarly, when you invest, the returns you earn can be reinvested, generating even more returns. This cycle repeats itself, causing your money to grow exponentially over time. Now, imagine two people, Alice and Bob. Alice begins investing at 25 while Bob waits until he's 40. Even if they invest the same amount of money at the same rate of return, Alice's portfolio will be significantly larger than Bob's by the time they're both 65. Why? Because Alice gave her money more time to grow. This growth can be particularly beneficial for those aiming to retire on dividends alone. The larger your investment portfolio, the larger your potential dividends. The longer your investment period, the larger your potential returns. So, starting early doesn't just mean more time to invest. It means more time to grow your dividends, more time to reinvest those dividends, and ultimately more potential income in retirement. Remember, time is money, especially when it comes to investing. Choosing the right companies to invest in is critical for a dividend-based retirement. Let's delve into the factors you should consider when making these important decisions. Firstly, the dividend yield. This is the annual dividend payment divided by the market price of the stock. It's expressed as a percentage and essentially tells you how much bang for your buck you're getting from your investment. A higher yield can mean more income for you, but it's not the only factor to consider. Which brings us to the second point, the company's history of paying dividends. Companies with a long track record of regular and increasing dividends are typically more reliable for dividend investors. These blue-chip companies, often in sectors like utilities, consumer staples, or healthcare, are generally stable and profitable, allowing them to consistently share their earnings with investors. Now, you might be thinking, why not just invest in the companies with the highest dividend yields? Well, that's where the third factor comes into play, diversification. Investing all your money in a single sector or company, no matter how attractive the dividend yield, is risky. Diversification, or spreading your investments across different sectors and companies, helps manage this risk. If one company or sector struggles, others may be thriving, keeping your income stream steady. Remember, though, that diversification doesn't mean just adding more companies to your portfolio. It's about finding a balanced mix of companies that can weather different economic conditions. Some companies might be more volatile but offer high growth potential, while others could be stable with modest but steady returns. Lastly, always consider your own comfort level and financial goals. Investing isn't a one-size-fits-all game. What works for one person might not work for another, so take the time to understand what you're investing in and ensure it aligns with your retirement goals and risk tolerance. By choosing wisely, you can ensure a steady stream of income during retirement. And reinvesting dividends can be a powerful tool to grow your retirement fund. Now, you may be wondering, what exactly does reinvesting dividends mean? Well, it's a straightforward concept. Instead of taking your dividends as cash, you reinvest them by buying more shares of the company that paid you the dividends. Picture this. You own shares in a company and they pay you dividends. You then use these dividends to buy more shares in the same company. Now you own more shares, which means next time the company pays dividends, you'll receive even more. This cycle repeats, leading to exponential growth over time. Now this is where a DRIP, or a dividend reinvestment plan, comes into play. A DRIP is a program offered by many companies that allows investors to reinvest their cash dividends by purchasing additional shares or fractional shares on the dividend payment date. By enrolling in a DRIP, you can automate this process, making it easier to consistently reinvest your dividends. The power of reinvesting dividends lies in the magic of compounding. Compounding is the process where you earn returns not just on your original investment, but also on the returns that investment has already generated. In the case of dividends, this means you're earning returns on your returns. Reinvestment can turn a small stream of dividends into a mighty river of retirement income. By consistently reinvesting your dividends over time, you can significantly increase the size of your retirement fund. Let's recap what we've learned about retiring on dividends alone. We started our journey by understanding what dividends are. They're not just a fancy financial term, but a share of a company's profits that's distributed to its stockholders. Simply put, when you invest in a company's stocks, you're buying a piece of its future profits. Then we moved on to the importance of starting to invest early. Time is a powerful ally when it comes to investing. The more time you have, the more your investments can grow, thanks to the magic of compounding. The earlier you start investing, the more dividends you'll accumulate over time, paving the way for a comfortable retirement. We also delved into the process of choosing the right companies to invest in. Not all companies are created equal. Some are more likely to provide steady dividends than others. The key is to look for companies that have a history of consistent growth and profitability, a strong competitive position, and a commitment to returning profits to shareholders in the form of dividends. Next, we discussed the strategy of reinvesting dividends. By plowing your dividends back into buying more shares, you can supercharge the growth of your investments. It's a simple but powerful strategy that can make a big difference in your retirement savings over the long term. But remember, investing is not a one-size-fits-all endeavor. What works for one person may not work for another. It's important to assess your own financial situation, your risk tolerance, and your retirement goals before devising your investment strategy. And let's not forget, investing is not just about making money. It's about securing your financial future, achieving your dreams, and enjoying a stress-free retirement. It's about having the freedom to live life on your own terms. So what are you waiting for? The journey to a dividend-based retirement starts today. Start investing, start building your future. And remember, every step you take towards financial independence is a step towards a better, more secure future. Thank you for joining us at House Lux Estate. We hope this video has given you a better understanding of how to retire on dividends alone. If you found this video helpful, don't forget to subscribe to our channel. We'll be sharing more financial wisdom to help you navigate your financial journey. Remember, the journey to a dividend-based retirement starts today. Thank you for joining us at House Lux Estate. Don't forget to subscribe for more financial wisdom.